Choosing where to make early withdrawals from a retirement account for expected expenses is a little bit like getting stuck in nasty traffic on the way to your friend's wedding and seeing all red on Google Maps. You might not love any of the options, but some routes are likely to be far better than others. All right, so today, Spencer, we want to talk about early withdrawals from retirement accounts. What are some key things that we need to know right off the start?
Well, the PSA that we want to give at the outset: get a primary reserve, 3 to 6 months of living expenses. We've got other videos on that, how to do that. And secondarily, if you can't do that, then have also an exploration about whether you could do a home equity line of credit to be able to tap in for some of these resources that you might need if it's short term. Now, if neither one of those work, then here we are talking about taking from retirement accounts. And the first one that we want to talk about is the Roth IRA, because you can often do that penalty-free up to a certain amount. So a Roth IRA, if you're not familiar, you're putting in after-tax contributions into this account. They grow tax-free, provided that you take them out in qualified ways. But the silver lining here is you can always take out the principal that you've contributed at any point without penalty. So let's just say you've been funding this Roth IRA. It has an account value of $100,000. You've put $50,000 in there and you need to do some kind of home repair at the last minute. Why, you could take out $20,000 for that home repair that you might need, because that's the principal contribution that you've made. Now, if you can avoid doing that, it's still nice to avoid doing that, because a Roth IRA, those contributions, and that growth tax-free is really a good thing. But that's one way that you can do this penalty-free. That would be kind of that silver lining and that secondary reserve of sorts. So taking principal contributions from your Roth is one strategy, but you might need to go above and beyond that. So can you talk us through what are some of the exceptions, even as we look at having to tap into earnings in that Roth IRA?
Right, exactly. So as we think about the earnings, if we take those out, if there's some exception, the global exception is turn 59 and a half and have it open for at least 5 years. So once you've done that, it's tax-free, penalty-free. But if you're younger than 59 and a half, there are some exceptions. They will still incur tax, but you won't get the 10% penalty. So some of those are first-time home purchases up to $10,000. Education expenses, qualified at higher education expenses, can be penalty-free. Medical expenses exceeding 7.5% of your AGI. So you have to know what your AGI is, exceed that 7.5% threshold, and then those unreimbursed medical expenses. If you've got disability or a substantially equal periodic payment that's similar to traditional IRAs, again, you'll still have tax, but you won't pay the 10% penalty on that withdrawal. So what are some strategies that we can incorporate here, Spencer?
Well, again, we would start here if we need to take some withdrawals, and we can do that on the principal contributions. That would be why we would focus first on the Roth IRA. These other pieces certainly could be useful in some sets of circumstances, but oftentimes it's not going to be applicable in one. And so if we had to take that withdrawal, it's quite a penalty, because you got the 10% penalty, but then you're also not getting the earnings tax-free as you would otherwise if you wait until 59 and a half and have 5 years of Roth open.
Right. And again, this we want to try to avoid it, but there are some times where you have to do it. Yeah. Okay, so let's talk about the second piece, 401k, 403bs. There's options here, again, before 59 and a half that you can take it out penalty-free. But walk us through what that is.
So there's two circumstances where a 401k can be particularly helpful. One is if you have a small amount that you need and you're able to take a loan. So again, we would say exhaust these other steps, use your primary reserve, explore a HELOC. If you have principal contributions to a Roth, do all those things first. But if we get to a point where you've got a significant balance in your 401k, you need a distribution desperately, and don't have any other options, then you may be able to take a loan from that 401k. Again, this is not the first lever that we pull, but you might be able to take a loan. The other thing is, if you retire and you are at least age 55 or older, there is what is known as 55 and separation of service from the 401k that will allow you to take out a distribution penalty-free. Now, that doesn't mean tax-free. It just means you don't have that extra 10% penalty on the withdrawal. Right. So if you're taxed at a marginal rate that's 22%, let's just say, then you still owe that on any pre-tax withdrawals from your 401k, even if you're not penalized there.
With a 401k, there's two other ways. We don't want to say these are strategies that you should pursue, but there are options sometimes within a plan for hardship withdrawals. And if you are going through a divorce or have gone through a divorce, you might be able to do a QDRO, qualified domestic relations order. Again, these are not strategies that you should pursue. However, they may be options to you. So when we think about the strategies with a 401k, if we don't have any of those options, what should we do with our 401k?
Well, the only other option that we have is to roll it to a traditional IRA and then use some of those options that we just talked about. But the first two, again, that would be primary and would be really helpful within that 401k, think about a loan and think about 55 and separation of service. Those can be two of the levers that we can pull that are kind of unique to a 401k relative to these other options that we're talking about.
Yeah. Okay, so the next one we want to talk about is the traditional IRA, similar to a 401k, but it's not held with your employer-sponsored plan. It's custodied at a different location. So again, it's very similar. If you try to take funds out before 59 and a half, there's a 10% penalty as well as regular income tax. So what are some things that we need to think through with withdrawals from a traditional IRA?
Well, this is one of those places that we'd say, don't do this, but then there's an asterisk there and there's a whole lot of verbiage below the asterisk. So there are a lot of different exceptions here and we can kind of walk through these. This, again, withdrawing from a traditional IRA would be one of those last resort things that we would not want to do because you typically do have the amount of tax and the penalty that's due. But it would be, say, for a first-time home purchase, up to $10,000, again, can be withdrawn penalty-free, not tax-free, but penalty-free there for that first-time home purchase. For educational expenses, medical expenses, with the same provisions that you talked about, disability. And then the thing that we would come back to here that would be more common, if none of these apply, then sometimes we will look at this provision that's sometimes called a 72T distribution, which goes by the IRS code there. But it basically allows you, if you are prior to age 59 and a half, to take out substantially equal periodic payments, which certainly is a mouthful. But you can set up this plan where you're taking out distributions, and sometimes this might be 4 or 5% of the account value. There are a lot of rules around it. You have to keep it going. The challenge with it really is that you've got to take these withdrawals and you got to do it over an extended period of time, and it locks up the value of that particular account. You can't take out other distributions from the account without penalties. So there's a whole lot to that we won't get into in terms of how you can do that. Just know that it is an option, a last resort option that can get you around the penalty, sometimes that 10% penalty. But again, it's not going to get you around the ordinary income tax that you're going to have to pay.
Right. Okay. So next, let's take a look at 457 plans. 457 plans are unique to certain nonprofit employers. What are some key things that we need to know about 457 plans and the options that you have therein?
A lot of these 457 plans are set up by governmental institutions. The key to the 457 plan, and this would oftentimes be a situation where we'd see a client with a 401k, a 457, and maybe an IRA or a Roth IRA, and we're saying, well, which place do we go here? If a client has retired and they have a 457 plan, even if they're age 51, they can take penalty-free withdrawals. So that is the one provision within that 457 plan that we like, and sometimes that we can tap into, that sometimes folks are not aware of if they have worked for the government for many years and maybe they saved in a variety of different vehicles. That 457 can be the one that we tap into first there if they need retirement distributions, again, early in retirement. Otherwise, we've got a lot of the same provisions. We've got a 10% penalty. You're paying ordinary income tax, on this. It's not a place that we would go to, say, if you're during your working years and you're in your 30s or 40s and need a hardship distribution. That's not going to be the first place that we're going to look.
Yeah. Okay, so the next one we're going to talk about is health savings accounts. We talk about these as the triple tax benefit. You get a tax deduction on the front end going in. You get tax-free growth in that account. And then when you take those distributions, if they are for qualified medical expenses, you get tax-free coming out. And so there's really a nice benefit to health savings accounts. And if you have a health savings account, not everyone does, but if you do, there are ways that you can structure this to get funds out. So you want to talk us through some of those extra benefits with a health savings account.
Well, this can be helpful for smaller needs in terms of amounts oftentimes. For instance, we've had clients that their health savings account might have grown to $50 or $60 or even $100,000. So it's a pretty sizable account. And what they're trying to do, they might need $10,000 or $15,000 for an emergency or an immediate need there. If they have not been taking distributions from that HSA for many years and they still have the medical receipts that are there, they can kind of back claim, those medical expenses, take out a distribution from a health savings account and count that distribution against those expenses as a reimbursement, of sorts. So let's just say, you've been saving to your health savings account $7,000 every year for the last 10 years, and you've seen some growth in that account. You've got $100,000 in that account now. And let's say you've been having $5,000 of medical expenses every year for the last 5 years, and those have been unreimbursed. But you have the records, you have the receipts. And let's say you need $25,000 in short order to be able to handle a different expense. Why, you could take the resources from the HSA, again, provided that you have the documentation there and the amount in the HSA, you could take that penalty free, as that is technically just a reimbursement of all of these expenses that you've had over the last 5 years. Now, again, you can't go back on those expenses and those reimbursements prior to the time that you had an HSA. You can't double reimburse yourself. There's a whole lot of different ways that you can hang yourself on this strategy, but we have seen this work in a number of different circumstances where the amount is fairly small that's needed for a distribution. It can come from an HSA and it can be done tax-free.
Yeah. So one of those other exceptions that you can think of with an HSA is if you're 65 and older. So talk us through that one.
Yeah, so a 65 and older exception there, it's basically just treated as an IRA. So let's just say, you have $100,000 in your HSA, you can't get your resources otherwise for one reason or another, and you need a distribution for non-medical expenses. You don't have any kind of penalty, but you do have to pay tax on that distribution. It's not a tax-free distribution like you would get typically from an HSA for qualified expenses, or that you would get for a Roth distribution if it was a qualified distribution. Instead, that income would be taxable to you. So one of the ways that you can get those resources out, and it can make sense. I mean, even if you're in your late 80s and you've got a big HSA and you're unlikely to use those resources through your lifetime, we see some clients that will start to take out distributions from an HSA just because they don't think that they'll use all of it in their lifetime.
Right. So we got two more that we're going to talk through. The first is the 529 plan. So the 529 plan is set aside for education savings. So if you take out funds for qualified education expenses, they come out penalty-free and tax-free. Now, the problem is if you don't use all of those, you still can tap into those resources, but there are penalties, there are taxes. So you walk us through the 529 and how taking a distribution from that can make sense.
Well, if you don't take distributions for qualified educational expenses, which this has been broadened a little bit, it is K through 12 expenses up to $10,000 a year now. It is any kind of higher education expenses, be that at a 4-year college or a 2-year school or trade school or whatever it might be. It's a pretty broad set of characteristics there that you can take resources out. It has to be done during the year that you have the expense, though. So this is unlike the HSA that we just talked about. You can't just say, oh, well, I never reimbursed that expense that Billy, my son, had 10 years ago in college. I'll just take out the 529 now. No, it has to be done year to year there, and you have to have the receipts, of course, for it to be qualified. If you don't take it out for a qualified educational expense, you have two pieces that you have to be aware of. Now, this is only on the earnings from the 529, but you do have to pay ordinary income tax on those earnings and a 10% penalty, typically. So let's just say a couple different scenarios. One scenario is you didn't see much gain in that account. So the $50,000 that you put in, it only grew to $60,000. Well, now you've only got $10,000 to get access to the entire account, $10,000 of gain that you're going to have to pay ordinary income tax on and that 10% penalty, should you want to tap into all of it there. The other side of things is, let's just say the 529 did really well and you put in $50,000 and it grew to $200,000. Why, now you've got a whole lot of gain and you would have a whole lot of penalty due relative in that situation. So it is based on the amount of gain that you have. If you had a circumstance where you invested those funds and they actually went down, you could take out the entire amount penalty free there and tax free there for that matter. So it is based on, again, the gain and some of those key provisions.
And just like some of those other accounts, there are some exceptions that you can work through. If you get a scholarship, you can withdraw up to the amount of scholarship without that 10% penalty. In this scenario, the withdrawal still is going to get counted on with the ordinary income on the gain amount. If you go to a military academy, Withdrawals up to the cost of education are also penalty-free, likely still on those gains taxable at that ordinary income level. So you can't get off scot-free, but there are some exceptions that we need to highlight that are there. Anything else with the 529 before we move on to new annuities?
I don't think so. Usually when we have these acute needs, we're looking at folks that are, say, during their working years, and they're not going to have, the options that we just enumerated. But if you do have a son or daughter that has that scholarship, went to a military academy at the same time that you have the need, then you might be able to get around the penalty.
Yeah. The other strategy here is that if your child doesn't go, but you have another child that needs a significant amount for college, maybe they didn't get the scholarships or go to the military academy, you can change the beneficiary on a 529 account. And so oftentimes there, you just want to have those conversations with your loved ones of saying, hey, this is why we're shifting this over. Maybe we're going to equalize gifts later. It comes in a bigger strategy. But if you come to a point where you've got an overfunded 529, one beneficiary is not going to use it, but another might. Let's have a conversation with those beneficiaries. All right, so lastly, let's talk about annuities, Spencer. What do we need to know about annuities and withdrawals and penalties therein?
Well, we've got a couple of challenges with an annuity. You've got a contractual agreement here. And if you violate the contract terms, you may have a penalty from the provider. So it wouldn't be uncommon if you had just made the investment in an annuity and there was some kind of penalty from the provider. You might have a 5 or 6 or 8% penalty from the provider, number one. Then you would also have a penalty for withdrawals from the government potentially, and ordinary income tax on any of the gain that you had there. So lots of different layers. And that's why we wouldn't typically look at an annuity as a place to take these early withdrawals. Now, there are circumstances that we could get into. If you became disabled, we could also look at substantially equal periodic payments, again, those 72T distributions. Or if you pass away, then your heirs will be able to take those distributions at a point where they're not penalized with a 10% penalty. They're still going to have to pay ordinary income tax on the gain amount there. But annuities, again, would be that absolute last resort because they tend to be less liquid, less easy to work with prior to age 59 and a half.
And as you've seen with any of these circumstances, there's not getting around the taxation piece oftentimes. Now, with the Roth IRA, with HSA, with some of these qualified expenses, you might be able to get around some of that tax, but there's often going to be a tax hit. So just know that going in. You're not going to be able to avoid taxes here, but some of the penalties are what we're trying to navigate around because we don't want to layer on a 22% ordinary income plus a 10% penalty. And then if you've got a 5% penalty as well from the annuity company, that gets real painful real quick. So in any of these circumstances, the reality is we want to be really wise when it comes to distributions. Clients, if you have questions about this, we would love to talk with you. If you're not a client, please take this information to your financial advisor. If you've got a hardship that's coming up that you need to take a withdrawal, really work with a professional here to try to minimize the pain. And with that, we hope you enjoy this content. Feel free to leave a comment below, and we'll see you again next time. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.